Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 28th, with John Mousseau, CEO, Director of Fixed Income. Moose, on the equity side and the broad indices, more of a grind. We've seen that now really all of April. S&P's up, I guess, a half a point, maybe 1% for April. There have been some outsized moves in individual names, primarily where earnings weren't as bad as feared,
right,
or better than feared, right? We saw a nice move in Microsoft. We've seen a nice move in some industrials that had gotten beaten down. But in terms of broad equity, just still in that range. We approach 4,200 and probably closing out the day somewhere around 4,150 today. You start seeing a little bit of selling coming in.
Every time you hit that upper range, it's like rock'em sock'em robots.
That's it.
That's it.
And on now, if we were going to look at this week and try to find a positive, because we always talk about this, right? What can go wrong in the markets? What can go right? As you're looking at the markets, where can you get in trouble? Where can you take advantage? If we were going to try to find a positive, it's that in that pretty nasty early to midweek drawdown, some real demand came in at a higher level than the previous drawdown.
Good sign.
May not mean anything, but we do look for higher bottoms. It's only a bottom if the market can continue to lift from here. So we'll watch that from a technical standpoint. You had an awfully busy week in interest rates. What do you have?
We did. Really across the yield curve, down about 15 basis points or so. As we're going out here on Friday, the 10 years at a 345, the 5-year bond is at a 350, 2-year bonds around a 405. What this is a little bit of coming back down. Again, you've had interest rates come down certainly since the banking crisis in March. It went a little lower, backed up. This is kind of backing and filling. Along with this are numbers like today, where you had pretty good PCE numbers on the Fed's favorite measure of inflation. We have one chart just showing GDP, which came out this week. And you're at that 1.1% level. And what you can see on this chart is you can see the big drop down as we hit COVID, the big spike up as we got all the stimulus and came out of COVID. And now you're basically bumping along right where you were before this. Another sign that this is reversion of the mean. The Fed likes this. The Fed is watching for continued signs of slowing down in inflation and stability in markets. We'll know more with the jobs number next week.
So although we have positions on and plans of where we want to allocate, we still have to be aware that the markets can be a victim to short-term moves out of the banking and financial area.
Sure, and that will certainly continue as some of this news unravels, right, with like either First Republic or any other banks that come down the road.
Right. The shock within the banking system creates ripples that hit all indices and multiple industries and sectors. So we have to be aware that we do have some cash on the sideline. We continue to look for opportunities, whether they are adding more to growth on pullback or looking for a reversion to the mean trade in value.
Correct.
Just like we saw a reversion to the mean trade the first 4 months in growth. We'll see what next week brings. In terms of the weekend, enjoy it. Be restful. We've got Apple, a whole nother slew of earnings reports next week. I know they'll keep you on your toes.
And don't forget, next week we'll have our Kentucky Derby picks.
That's right. We'll see if we can win one of these years.
Exactly.
All right. Enjoy the weekend.